22. Depreciation on equipment must be written off at 20% per annum according to the fixed installment method. The cost price of equipment is 560,000 Rand and the balance of the accumulated depreciation account on the 1st of March 2024 was 490,000 Rand. So we now first need to do a calculation for depreciation. Okay, so they are saying it's the fixed installment method. So let's quickly work it out. So our depreciation will be, we take our cost price, we times it by the rate and by the months. Our cost price given was 560,000 Rand. The rate is 20%. It's for a full year, 12 over 12. So we get 112,000 Rand. But now we have a problem because the carrying value method is being used. So according to the accumulated depreciation balance method or the carrying value method, the formula is you take your cost price, you minus your opening balance on the 1st of March. So 560,000 Rand is your cost price. Your opening balance thus far is 490,000 Rand. So it gives us 70,000 Rand. That is the total depreciation that we can still write off for this vehicle. So when we calculated using the fixed price, we got 112,000 Rand. The vehicle is only worth 70,000 Rand after this current year end. So now we have to apply the 1 Rand rule clause where we say 70,000 Rand and we deduct 1 Rand. So the total value is 69,999 Rand. That is the total value of depreciation left for this vehicle, and we cannot make a vehicle worth 0, so thereafter the vehicle will be recorded as a value of 1 Rand in our books. So let's determine the two ledger accounts involved. First account is depreciation, and the second account is accumulated depreciation on equipment. Depreciation will be classified as an owner's equity, and accumulated depreciation is classified as an asset. Depreciation has a negative effect on owner's equity, and accumulated depreciation also has a negative effect. Let's record this into our answer sheet. The subsidiary journal is your general journal. The source document is your journal voucher. Account debited was depreciation. Account credited was accumulated depreciation on equipment. 69,999 in the debit column of equity and 69,999 in the credit column of assets. Number 23. Depreciation on vehicles is written off at 10% per year on the diminishing balance method. The business owns only one delivery truck. The truck was bought on the 1st of June 2023 at a cost price of 480,000 Rand. So we're first going to have to calculate our depreciation for the year. We know this year will run from 1 June 2024 till 28 February 2025, which is a total of 9 months. So in order to calculate our depreciation, we're going to take our cost price times the rate given times the number of months. In this case, the cost price is 480,000 Rand. The rate is 10%, and it's only a duration of 9 months, so 9 over 12, which gives you 36,000 Rand. Now that you have your depreciation for the year, we can now calculate the depreciation, because the method in this transaction that is being used is the diminishing balance method, also known as the carrying value method. The formula is slightly different. You now not only take your cost price, but you have to first deduct your accumulated depreciation, then you times it by the rate, then by the months. So our cost price is 480,000 Rand. We just calculated that our depreciation for this year must be another 36,000 Rand, that must come off. Then you times it by 10% for the whole year, and you get an answer of 44,400 Rand. So let's determine the ledger account involved. Your first account is depreciation, and your second account is accumulated depreciation on vehicles. Let's classify each account. Depreciation is an owner's equity. Accumulated depreciation on vehicles is an asset. Depreciation has a negative effect on owner's equity, and assets has a negative effect on accumulated depreciation. Let's record this onto our answer sheet. The journal used is the general journal. The source document is the journal voucher. Account to be debited is depreciation. Account to be credited is accumulated depreciation on vehicles. The amount is 44,400 to be debited in equity, and 44,400 to be credited under assets. Number 24. Rental expenses for January 2025 and February 2025 are still outstanding. The rental expense amounted to 18,500 Rand per month and increases by 8% on the 1st of January every year. So first of all, we have to calculate the new rental to be paid. It is outstanding for 2 months, January and February. We know that we always used to pay 18,500 Rand, but now it's going up with 8%. So if you say 18,500 Rand plus 8%, you get a new amount of 19,980 Rand. Because it's outstanding for January and February, we're going to multiply that by 2. So our total rental outstanding is 39,960 Rand. So the two ledger accounts involved will be rent expense, and anything that is still outstanding, we open a new account called accumulated expense. Accumulated expense is a liability. Rent expense is an owner's equity. Rent expense will have a negative effect on owner's equity, and accumulated expense will have a positive effect on the liability. So let's put that onto our answer sheet. So number 24, our journal is the general journal. Our source document is our journal voucher. The account debited was our rent expense account. The account credited was our new account called accumulated expense. Equity will be debited with 39,960 Rand. And liabilities will be credited with 39,960 Rand. Number 25. Interest on the fixed deposit at African Bank shows that a total amount of 12,000 Rand was received as interest during the year. An amount of 250,000 Rand was invested on the 31st of March 2022 at an interest rate of 6% per annum. On 1 November 2024, the interest rate decreased by 1.5%. An amount of 50,000 Rand was withdrawn from the fixed deposit on 1 January 2025. Okay, this is a bit complex because we are dealing with different amounts, different interest rates, and different dates. So let's break it up. You can either do this on a timeline, or you can write it out like I'm going to explain to you. So we need to work out our interest on the fixed deposit. Firstly, this year runs from the 1st of March till the 1st of November is going to be your first cut-off date, because on the 1st of November the interest rate decreased. So we'll have to break up the calculation. So if you count the number of months from 1 March to 1 November, we get a total of 8 months. So our full fixed deposit is 250,000 Rand at our higher rate of 6% for 8 months. Gives you 10,000 Rand. But then from the 1st of November till the 1st of January, something happened. What happened? Our interest rate decreased by 1.5%. So we now no longer earn 6% interest per annum, but we only earn 4.5%. 6% minus 1.5% gives you 4.5%. And that was for November and December. Once again, we're breaking it up again because from 1 January, our fixed deposit amount changed. So now we are earning interest of 4.5% on a value of 250,000 Rand, but only for 2 months, November and December, and that gives us 1875. The last part of this calculation is our last 2 months of this year, which is January and February, but something more happened. Our fixed deposit got reduced by 50,000 Rand. So we are now only earning interest on a balance of 200,000. 250,000 minus 50,000 gives you 200,000 times a rate of 4.5% for 2 months, which is January and February, and that gives you an answer of 1,500 Rand. So our total interest that we earned for the year was 10,000 Rand plus 1,875 Rand plus 1,500 Rand, which gives you 13,375 Rand. But if you go back to the transaction, you will see that we only earned 12,000 Rand that we have received. So in other words, 13,375 Rand is the total that we should have received. We've only received 12,000. So the difference of 1,375 Rand is still accumulated income due to us to be received. So now we can record it. Our 2 ledger accounts will be accumulated income, and our other ledger account is interest on fixed deposit. Accumulated income is an asset, and it has a positive effect. Interest on fixed deposit is an owner's equity, and it also has a positive effect on owner's equity. So let's record this into our worksheet. So the journal involved is your general journal. Your source document is your journal voucher. Account debited is accumulated income. Account credited is interest on fixed deposit. Owner's equity will be credited with 1,375 Rand, and assets will be debited with 1,375 Rand. Number 26. The insurance premium has already been paid up to the end of June 2025. The total amount paid amounts to 65,600. So by reading this transaction, we have to calculate our insurance that we were supposed to pay for this year. According to the time frame given, we paid too much. So we've got to work out how many months did we overpay. Our year runs from 1 March 2024 till 28 February 2025. But we have paid up until 30 June 2025. So we paid an additional 4 months. So in other words, we paid the 12 months that we should have, plus another 4 months, which is March, April, May, June, which gives us a total of 16 months. So the total of 65,600 Rand is for a total of 16 months. So to calculate what we pay per month, we're going to say 65,600, divide that by 16 months, gives you 4,100 Rand per month. So in other words, March, April, May, and June is 4 months that should not have been included this year. So 4,100 Rand times 4 is a total of 16,400 Rand that we paid too much. So therefore, the part that we paid too much is known as a prepaid expense. So our 2 ledger accounts involved will be prepaid expense and insurance. Prepaid expense is classified as an asset, and it will have a negative effect. Insurance is classified as an owner's equity, and it will have a positive effect on owner's equity. So let's put all of this information onto our answer sheet. The journal involved is your general journal. Your source document is your journal voucher. The account to be debited is prepaid expense. The account to be credited is your insurance expense account. Your equity account will be credited with 16,400 Rand, and your asset will be debited with 16,400 Rand. Number 27. Rental income shows a total of 131,195 Rand. The rent for March 2025 has already been received. The rental was increased with 9% on 1 July 2024. First, we have to calculate the rental income that we received in advance, because we received up until the end of 31 March 2025, but our year end ends on the 1st of March 2025. So this will involve a calculation. Okay, again, it's a bit complex because they don't give us the amount of rent that we received before the increase and the amount after the increase. They only give us the increase percentage. So we're going to have to draw a timeline and have our date specific to see how to calculate this. Our first time frame will run from 1 March 2024 to 31 March 2025, which we can calculate is a total of 13 months. So the amount of 131,195 Rand is for a total of 13 months. If we break those 13 months up, 1 March 2024 till 30 June 2024 is 4 months. We classify that as X. That is the amount that we received for rental before the increase. Then we read from 1 July it increased by 9%. So 1 July 2024 to 31 March 2025 is an additional 9 months in which we earned X plus 9% more. So now we put all of this into an equation. So we are going to say 131,195 Rand equals 4x, that was the period 1 March to 30 June before the increase, plus then for 9 months in brackets, we will get X plus 9% more. So then if we calculate X, we get 13.81X. So now we're going to say 131,195. We're going to divide that by 13.81. So the value of X is 9,500 Rand. So in other words, for 4 months, we received 9,500 Rand, but then for 9 months, we received 9,500 Rand plus an additional 9%, which gives you 10,355 Rand. So instead of receiving rental income for a full 12-month period, we received for 13 months, so 1 month is income received in advance, and that amount for 1 month that was received in advance is 10,355 Rand. Let's put this onto our worksheet. So the 2 ledger accounts involved is rent income. The second one is income received in advance. Rent income is classified as an owner's equity, and it will have a negative effect. Income received in advance is classified as a liability, and it will have a positive effect. The journal involved is our general journal. The source document is our journal voucher. The account to be debited is rent income. The account to be credited is income received in advance. Owner's equity will be debited with 10,355 Rand, and liabilities will be credited with 10,355 Rand. An EFT for 45,900 Rand was made to the South African Revenue Service for monthly tax deductions from salary and wages. Our 2 accounts will be our said LBS ledger account and our bank account. Let's classify both. Said LBS is a liability. Bank is an asset. It will have a negative effect on asset as we're withdrawing money to pay for salaries, and the liability will also have a negative effect. Let's put this onto our answer sheet. So the journal involved is your cash payments journal because you are making a payment. It's directly from your bank account, so it's an EFT. The account debited was said LBS. The account credited is bank. Under liabilities, you will have 45,900 in the debit column. And under assets, you will have 45,900 in the credit column. Number 29. It was discovered that inventory to the value of 3,375 Rand had been stolen out of the shop. Your two ledger accounts will be lost due to theft and inventory. Anything stolen, we open an account called lost due to theft. Lost due to theft is classified as an owner's equity and it will have a negative effect. Inventory is classified as an asset and it will also have a negative effect as stock is now stolen and it's decreasing our stock levels. Let's record this on our worksheet. The journal involved is your general journal. The source document is your journal voucher. Account to be debited is lost due to theft. Account to be credited is inventory. Equity will be debited with 3,375 Rand and assets will be credited with 3,375 Rand. Number 30. The inventory account reflects a balance of 65,000 Rand. A physical inventory count was performed and reflects the value of inventory on hand as 59,000 Rand. First of all, it will involve a calculation. We will have to calculate the inventory deficit. If we started with 65,000 Rand and we now only have 59,000 Rand, that deficit is called a deficit. The two ledger accounts that you will open is called inventory deficit and inventory. Inventory deficit is classified as an owner's equity and it will have a negative effect on owner's equity. Inventory is classified as an asset. It will be credited and it will also have a negative effect on assets. Let's record this onto our answer sheet. So the journal involved is your general journal. The source document is your journal voucher. Account to be debited is your inventory deficit account. Account to be credited is your inventory account. 6,000 Rand in the debit side of equity and 6,000 Rand on the credit side of assets.